One thing that's interesting about the society we live in the age of information, with the internet making pretty much everything accessible to anyone who wants to learn about it or hear about it, is that the government and the Fed and everybody else can keep telling us how good the economy is and that there's nothing to worry about. But people and their psychology and the things that they look up online reveals a completely different story, especially this week with this viral thread going around about how the Google searches for help with mortgage haven't been this high since 2009. I mean, that's just data that doesn't lie right there. Like, there's no ulterior motive. There's no incentive to put this out there. Like, Google keeps track of what people search and how often they search it. And the search for help with mortgage hasn't been this high since 2009. That's pretty cut and dry information right there. And there's not much to read into. It means that a lot of people, more than ever since 2009, need help with their mortgage, and they're trying to find out some desperate solutions to keep their house. Now, Google Trends doesn't show the exact number of searches. It just shows the search volume, meaning that, it's high or low or medium or whatever, but it doesn't show exactly how many people are looking at this. And that's right away one of the reasons why all the economists say, well, you shouldn't worry about that. We don't even know how many people are searching this. Just because it's just as high as it was back then doesn't really mean anything. Well, I think it means everything. I mean, it doesn't really matter what the search volume is, if you ask me, because if the level is just as high as it was in 2008 or 2009, clearly that means we have a problem on our hands. Who cares what the actual number is? Does it matter if it's 5 million people or 8 million people? It's still a lot of people that are searching this up all of a sudden. And interestingly enough, the last time we saw a big spike in these search terms was in March of 2020, right at the beginning of the pandemic. This doesn't sound like a coincidence to me. By the way, today I'm walking in Corte Madera in Mariner Cove, and as you can see, it's kind of chilly today. Wearing jeans, long sleeves, the wind is blowing. It's like in the upper 60s, but it feels kind of more like the low 60s with the wind. But it's so funny that they tried to twist this into something where it's not that bad. Like, oh, well, this could just mean that people who are financially stable are looking up help with mortgage because they're trying to already preemptively look up mortgage assistance because they fear being laid off, for instance. Well, isn't that still a bad thing? Isn't it still bad that if somebody who is able to pay their mortgage right now and has a stable job right now is worried about being laid off? Isn't that a sign that the economy might not be as good as we're being told? Or how about this? It says also, recent search traffic may not be directly comparable to 2009 when internet adoption was less widespread. That's right. There's way more people use the internet and Google nowadays. So if the search volume is just as high as it was back then, that means it's probably even higher when adjusted for the amount of people looking this up. And it's not really that big of a coincidence either that this surge in help with mortgage searches is coming at a time when people are starting to miss their mortgage payments. The delinquency rates for mortgages have been steadily increasing throughout the year. In fact, as of July of 2025, there are 30,000 more households in serious delinquency, meaning 90 days late or more, than there were just a year ago. 30,000 households struggling sounds like a lot to me. And according to ICE, the primary driver of stress in the mortgage market is among those mortgages that are backed by the Federal Housing Administration. FHA loans accounted for 52% of serious delinquencies nationwide in July. Just take a look at this chart right here of the delinquency rate 6 months after loan origination, okay? That's only 6 months after you buy the house and you already can't pay the mortgage. Well, you see that back in the late 90s and the early 2000s, before the last big housing market crash, that number was pretty substantial, and then it went lower for a while, and then in 2020, it started increasing again, then kind of went down. But the numbers today are still a lot higher than they were after the 2008 crash. Why are people in this situation? Well, because of how easy it is to get an FHA loan. There's too much flexibility, guys. The borrowers can have a credit score as low as 580. You can have a down payment as low as 3.5% down, and even get that 3.5% covered by other loan programs available for low-income folks. Whereas a conventional mortgage requires you to have a higher down payment and a higher credit score and a stronger financial statement. What I think is going on here is I think a lot more people are in financial trouble and not able to pay their mortgage than we're being led to believe, not only because of this big uptick in the Google searches for it, but just from the fact that we know that the government has been artificially helping these people who have FHA loans, who have gone delinquent and have given them forbearances and are literally buying down their mortgage rates and using taxpayer money to do so and kind of paying their mortgage for them. This has already been proven to be happening on about 2 million properties nationwide. So imagine if all those people were in foreclosure right now, what that would do to the current housing market. And the only reason they're not is because of artificial government stimulus. But that's not going to last forever. That's going to come to an end at some point. We don't know when, but we know that it will. Just look at the foreclosure filings, okay? Foreclosure filings are up 18.1% as of August of 2025 compared to August of 2024. You don't think that's an alarm bell? You don't think that's something that we need to pay attention to? And then they just brush it off and say, well, you know, people are just searching stuff. Come on. Not to mention the foreclosure filings have been steadily rising for the last 6 months. And I'm not saying that we're at 2008 levels of foreclosure filings here. That's not what I'm saying. I'm just saying that we're still in the early stages of this and we need to pay close attention to what's going on because prices are already coming down in many areas across the country, even without a massive surge in foreclosures, even with the government helping all of the delinquent FHA borrowers. Imagine what the picture is going to look like when all that goes away. Here's something funny that this article says, and it kind of relates to the channel here. It says, for the doomer theories of 2008 redux to be true, you would need that sort of perfect storm: layoffs, falling house prices, and a high share of recent home purchases. Well, we definitely have a high share of layoffs. We definitely have falling home prices. The one thing we're missing from this is a big surge in recent home purchases. In fact, home purchases have been in the gutter for a while now. The last 2 or 3 years in a row, including this year, have been some of the worst home selling markets we've seen in like 30 years. But people who do own homes right now are wasting no time in refinancing. This is something that we kind of talked about a couple of weeks ago. And right away, when you hear this, it makes you think, well, the current homeowners are just taking advantage of lower interest rates, Michael. What's wrong with that? Well, what's wrong with that is the majority of people who are doing this, more than half, are doing what's called a cash out refinance. Right away, they say that, you know, Americans are jumping on the opportunity to refinance their home loans because the refinance applications went up 58% over this past week since mortgage rates have been coming down into the low sixes. But conveniently, they don't tell you what type of refinances they're doing. They just say that it's a refinance. But we know from ICE data as well that the majority of people who are refinancing are doing what's called a cash out refinance, where they pull money out of their house to use for whatever reason. Most likely, a lot of people are using it for living expenses right now because of inflation. And get this, they say that demand was even stronger for those seeking adjustable rate mortgages, which is where the borrowing costs fluctuate and are tied to the short-term interest rates in the economy. So the share of refinancing activity tied to adjustable rate mortgages rose to 13% in the last week, which is the highest share recorded since 2008. Do you think it's like a big coincidence that all these things that haven't really happened since 2008 are suddenly happening again? I think these are dead-on economic indicators of the current state of affairs. I think this is telling us exactly where we're at right now. But it's always different this time, right? That's one thing we've heard over the past few years. Well, this time it's different. Every time it's different. This time we have inflation. That's a major problem that we didn't have back in 2008. This time we have a job market that has been deteriorating since last year, even though the official unemployment rate is still sitting at 4.3%. Now, speaking of inflation, let's talk about this for a minute, because we know that the Fed just lowered interest rates a 1/4 percentage point. Ooh, that's going to really get us somewhere. But anyways, we know that that just happened this week, and a lot of people are wondering, what they should do, because inflation is guaranteed to be a problem moving forward. Because if we're lowering interest rates in an environment where inflation is continuing to go up, well, it's almost a certainty at this point that it will continue rising at an unknown rate. And a lot of people wonder, when things get this bad, if they should maybe take a look at buying real estate. Is this a good way to hedge against inflation? My answer to that is it kind of depends. Well, let's review some things here. One thing we got to look at is what inflation does when you want to build a house. In general, inflation makes building a house more expensive. So in theory, when home builders want to go and build a brand new house, their costs of development are going to be higher when inflation is higher. So naturally, they're going to push those expenses onto the buyers of those brand new construction homes, right? Right? Well, usually, but that's not what's happening right now. Right now, you can actually buy a brand new house for cheaper than an existing home in many parts of the country where brand new homes are available. And when brand new homes are selling at lower prices than existing homes, that tends to bring down the comparable sales of existing homes as well, which means those existing homes are now worth less too. But it is also true that in times of inflation, investors want to have hard assets like stocks, bonds, and real estate, gold and silver, things that have been proven to increase at or even beating the rate of inflation. Now notice how I said investors, because investors purchase investment real estate. And if you are purchasing investment real estate and you are receiving a positive cash flow each month and getting an actual cash on cash return on your investment each month, and simultaneously the value of your property is going up because of inflation, that's a good reason to buy real estate. That's why you hear all those guys like Robert Kiyosaki and Grant Cardone and everybody telling you that you need to invest in real estate and that's how you're going to become rich. However, the problem is the average person doesn't do that. They go out and they buy a residential property, usually close to the maximum of what they can actually afford, what they got approved for, and they live in the house and they say, well, look, I invested in real estate. This is my biggest investment. Hi.
Subscriber.
Oh, really?
Uh-huh.
What's your name?
My name is Sabrina.
Sabrina?
Yeah.
Nice to meet you, Sabrina.
Oh, nice to meet you too.
How are you?
I'm doing pretty good.
Are you working right now?
Yeah, I do Amazon Flex.
Okay,
Yeah,
cool.
nice. I like your when you talk about economy.
Yeah?
Yeah, is what because I'm driving around and it matches everything that you says. It matches with what I have seen when I'm driving around about economy and all that. So I like your opinion about it. I like to follow you.
Oh, I appreciate that.
Yeah.
Thank you.
Yeah, I saw that you were in Marin County once, but I have no idea that you were here again.
Yeah, here I am.
Yeah, nice to meet you.
What's your name?
My name is Sabrina.
Sabrina.
Yeah.
Nice to meet you, Sabrina.
Nice to meet you.
Well, I appreciate you watching my channel.
Oh, nice.
Thanks for stopping and say hello.
Oh, thank you.
Okay,
Have a great day.
bye, you too.
Thank you.
Shout out to Sabrina. Well, there you have it, guys. She's there doing Amazon Flex, and she's telling you that everything that I'm talking about here on the videos is something that she's seeing happen in real life, in the real economy, as she's hustling through the neighborhoods, delivering people's groceries. So just think about that next time you want to say, well, this isn't happening, that's not happening. Well, are you out there doing this? Are you out there working hard like she is and, delivering things for people and seeing what's really going on? Or are you just, sitting comfortably in front of your sofa watching the Bubble Vision News tell you what's going on? That's what you have to look at. Anyways, back to real estate being a hedge against inflation. What I was saying is that if you're just going to buy a property and live in it and pay the bills, that's not going to be a hedge against inflation for you, okay? If you own the property and you're going to actually, rent it out and create rental income, and you're going to see that property appreciate over the years, then the answer is potentially a yes. However, as somebody who has done this in the real world, I can tell you that it's very possible, especially in this environment, where you can buy a property that's cash flowing, and within just a few years, you might actually have a negative cash flow. And this is why. Because everybody thinks that landlords can just raise the rents every time the expenses go up for the property. And while landlords try to do that every time they can, if it's necessary, It's definitely not always possible because as a landlord, you can only charge what the fair market rents are for the neighborhood. So for example, if you own a house that's being rented out for $2,000 a month and your expenses have gone up substantially, and in order to break even, now you need to raise the rent to $2,300 a month, but the fair market rent in the neighborhood is still only $2,000, and there's other choices out there for your tenant to go and rent a house for $2,000 or maybe even $1,900 or $2,100. What is the reason they're going to pay you $23? Unless they really love your house, they're probably not going to. They're going to move. And so, because the expenses of owning a home and being a landlord have gone up so substantially over the past 5 years, you can easily buy a property that's cash flowing and then just a few years later be in a negative cash flow situation. And that was kind of like the future I saw for the investment properties that my wife and I used to own. And we decided to offload them before we were in a negative cash flow situation. And I'm very glad that we did. And we still gained some appreciation along the way. So if you can kind of time it properly like that, like we did, sure, it is a good hedge against inflation. You can make investment income along the way, and you get appreciation income, assuming you sell at the right time. But this is not even close to the same thing that most people do, which is that they go out, they get pre-approved for $250, and then the house of their dreams costs $275, and they find a way to get into that house and go above what they can really afford, and then the expenses of that house continue to go up, and they just can't hack it anymore. Is that a good investment? Is that a hedge against inflation? Not really. You just bought yourself a ticket to ever increasing inflation, because every time inflation goes up, so does your homeowner's insurance. So does your cost to repair anything on the house. So do your utility bills. Basically everything except for your principal and interest payment, assuming that is fixed, is going to be going up on that home in times of high inflation. So to answer the question, is buying a house a good hedge against inflation? Only if it's a good investment, meaning that it cash flows today and it's likely to cash flow at least into the next 3 to 5 years, and the value of that property is also going up. Because even if it's cash flowing and you buy in a neighborhood where the values are going down, well, it's not going to be a good hedge against inflation. You are essentially going to be losing money on that investment when you factor everything in. The only thing I will say is that the long-term comparisons kind of math out in favor of homeowners when you just look at mortgage payments versus rents, meaning that over a 30-year time frame, if you were to buy a house versus rent, then there's a good chance that you could come out ahead because your mortgage payments will remain more stable versus the average annual increase in rent, which is about 4.2%, even though right now rents have been coming down. But over a 30-year time frame, historically, that's what it's been. So when you look at it through that lens, sure, maybe owning a home over 30 years will be a better bet than renting. However, they're not taking into consideration an increase in property taxes. They're not taking into consideration any maintenance costs that you're going to have on the home and how inflation is going to affect that. And they're also not taking into consideration the fact that most people don't own a house for 30 years anymore. And every time you sell or refinance or whatever it is that you do, and you don't keep the home for 30 years, that's working against this type of math. And I think this very last story is a good example of the point I'm trying to illustrate here. Because according to Cotality, which was formerly CoreLogic, they came out with a chart recently that shows us there are only 14 states in the United States right now where homeowners have not been losing equity. Meaning that in all the other 36 states, homeowners have been losing equity, which means that if you are hoping that your home is a hedge against inflation right now, this is kind of working against you as well. Now, this doesn't mean that everyone's equity has evaporated, okay? Because the average US borrower still has about $307,000 in equity, but that's just the average. Remember, the average number is not a fair representation of what most people have, because it's an average, it's not the median. But take a look at this map right here, and what do you see? Only the states in red are the ones that are seeing a positive increase in equity year over year right now, and it's just a handful of states in the Midwest and the Northeast, which is not even a surprise because those are the only states that are hanging on right now in terms of home price appreciation and have much lower inventory than they did before the pandemic. But literally every other state in the country is seeing negative home equity gains year over year. So effectively, people are losing home equity year over year right now, almost everywhere. And I can tell you that those last remaining few Midwestern and Northeastern states are not going to hang on forever, guys. At some point, those places are going to turn negative too. We don't know when, but it's going to happen. The biggest losses were actually reported in Washington, D.C. at a whopping $34,400 in equity lost over the past year. In Florida, the average household lost over $32,000 in equity. And in Montana, the average homeowner lost almost $27,000 in home equity. These are major, major losses. So you're telling me at a time when the official inflation rate is around 3%, it's good to be losing $30K a year in equity? Even some of these other states that are not losing as much, like $14,000 in equity, Arizona's $21,000, Texas is $22,000, California's $24,000. Even the Midwestern states that don't have as much to lose, like Iowa, for example, they're negative $3,000 year over year. That might not sound like a lot, but if your house is only worth $150,000, well, $3,000 less is a bigger percentage than it would be on a house that loses $3,000 in value that's worth $500,000. Now, in contrast, the states with the highest gains were Connecticut, seeing 37,400 increase in equity year over year, New Jersey at 36,200 increase, and Rhode Island at $31,200 increase year over year. But my point remains the same, that buying real estate as a hedge against inflation probably isn't the best bet, especially under this environment, unless you can find a good cash flowing property in an area where values are increasing. But almost nowhere are values increasing right now. Pretty much exclusively needs to be in the Midwest or in the Northeast, and good luck finding a cash flowing property in many of these areas, because in most of these areas now, it is more expensive to be a homeowner than it is to be a renter, which means that you're not going to be able to find a cash flowing property. So almost under no circumstances right now is buying real estate a good hedge against inflation. At one point in the future, it will be again, but not until prices come down substantially in order to make it a good buy again. So that way there's room for appreciation, guys. Right now, there's really no room left for appreciation. That's why so many people are losing equity right now, because we're seeing depreciation. We're seeing deflation in the housing market. So let me know what you think about these Google searches. Let me know if you think we should take this seriously. I think this is about as serious of a warning as it gets, showing what real people are really looking up. That's going to tell us a clearer picture and more truth than anything you're ever going to hear on the news. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.